What's up, everybody? Today we're going to be doing something a little bit fun, a little bit different. We are going to be ranking all 7 of the Magnificent 7 stocks from S to D. You can see the logos for all 7 companies here. We have Amazon, Apple, Microsoft, Google, Meta, Nvidia, and Tesla. Now, they're called the Magnificent 7 for a reason. These stocks have not only performed incredibly well, but these are all high quality companies. They have excellent return on invested capital, excellent growth. I mean, you look at the fundamentals for these companies. I just have a sheet for Amazon up here, and you can just see they just have charts like this. Revenue, just a beautiful line up and to the right. Margins increasing over time. That's one sign of a dominant business. Not only is the revenue increasing, but they're also able to expand margins at the same time. Just to quickly compare all these companies, put all their tickers in here, and Tesla. So my sheet is just going to scrape a bunch of fundamental data from the internet so we can visualize it all really quickly. First thing you're going to see is these are all massive companies. I mean, Nvidia and Microsoft are about 3.5 trillion in market cap. Smallest company by market cap is Tesla at only $1 trillion. And just looking at revenue and operating income, these are massively profitable companies. Google, for example, about $360 billion of revenue over the past 12 months and 117 billion in operating income. We can get a quick glance of all their margins here, or you can also just look at this graph over here. The blue is gross margin, red is operating margin, and yellow is adjusted free cash flow margin. It's basically the free cash flow margin, but I adjust for share-based compensation. As equity owners, when we buy into these stocks, when we own equity in these stocks, share-based compensation is a real expense for us. So I adjust their free cash flow for that. We can see that 5 of these companies have operating margins over 30%. That is insane. Nvidia has the highest operating margin, followed by Microsoft and Meta. Google and Apple are pretty similar. Amazon and Tesla have slightly lower margins, which really isn't a surprise considering that these are really the only 2 businesses that are capital intensive. Just think about the massive amount of inventory in warehouses, trucks, all that Amazon has to have. And Tesla is manufacturing cars. You just cannot have the same margins for these types of companies as you can have with, for example, Microsoft, where the marginal cost for one more client for Microsoft, one more user of some Microsoft Office product, for example, is really a very low marginal expense to Microsoft. But the revenue is the same as all their other customers. So those types of asset-light businesses, they really benefit from economies of scale. Moving on to some valuation metrics, we can see that these are some pretty expensive companies. They're very high quality and very dominant companies, so it's not surprising, but you're paying over 30 times earnings for most of these companies. Amazon at 35, Microsoft at 36, Nvidia at 46. Now, all these numbers here are looking at the trailing 12 months. So you might argue, hey, forward earnings for Nvidia are going to be higher. So if you look at price to forward earnings, it wouldn't look as bad. And that's true, but we'll quickly look at just some future projections for each company when we rate them on this scale. One thing to note, across the board, Google definitely looks like the cheapest company here. I mean, they're trading at under 20 times operating cash flow, under 20 times earnings. That doesn't necessarily mean they're the best investment though. You have to think about growth, risk, how dominant these companies are, what is their moat. And speaking of moat, most of these companies here, I would argue, have a very strong moat. I recently did a video on Nvidia. They, in my opinion, have the strongest moat in the semiconductor space. Microsoft, I think, sometimes gets overlooked for how powerful their moat is. I mean, Microsoft Office, it's like it is embedded its thorns into almost every business on earth. In my opinion, I think it would be a lot easier for people to, switch the search engine they use than for a business which moves very slowly to try to move away from Microsoft Office. Google and Meta are basically a duopoly in digital advertising. Amazon, I think, has a couple big moats. One is just the convenience moat of just having next day delivery. I mean, no one is really close to competing with Amazon on that front. And the other is Amazon Web Services is really dominant and a very high margin part of this business that is becoming a larger and larger share of their pie every year. Frankly, as far as moats and competitive advantages go, it's really hard to pick bad companies here. But if I were to just compare them against each other, in my opinion, I would probably say that Nvidia, Microsoft, and Amazon have the 3 strongest moats. And I would put Google, Meta, and Apple in the next tier. And I just don't think the moat of Tesla really compares to these other 6, which is not to say it doesn't have any competitive advantages. I don't think it's quite in the same group of dominance as these other companies. And surprisingly, Tesla also trades for the most expensive multiples. When I did a bit more of a dive into Tesla and I looked at what I could expect for a return for my investment in Tesla stock today, I think the results were pretty disappointing. I assumed revenue growth of 15% every year for 5 years, which, just for comparison, they've actually been declining slightly the past couple years. I assumed operating margins of 10%, which would be absolutely fantastic for any car company, and a 30 times multiple, which is nothing to scoff at. But if these assumptions come true, you're going to be losing 8% every year for 5 years in Tesla stock. I just think Tesla stock is significantly overvalued today. It's just my opinion, but I'm going to put them down here. I got to put some company down here, and for me, it's Tesla. Now, my rankings don't reflect whether I think it's a good or a bad company. It's whether I think it's a good or bad investment. So it's also heavily based on what the price is today. What are we paying for these stocks? In the future, if Tesla's share price drops 80% or something, well, then I might start thinking it's a better investment. Maybe in the future, Microsoft is super expensive and I would put it down here. I'm just giving my opinion about the stocks as investments today, which is not the same as my opinion on the quality of the companies. Now, next up, I think I have to put Apple. Apple's a strong company, but growth is pretty moderate. I think if they continue with, mid to high single digit revenue growth and their margins remain quite good with, a 20 times multiple, which is maybe a little low. I mean, you could give them a little bit more, but I think you're looking at high single-digit returns. I think it's decent, but I don't think it's amazing. I'm going to give it a C, which may seem harsh, but these are some pretty incredible companies, and I want to kind of, use the whole scale here. I don't want to make everything S, A, and Bs. All right, I was going to just go from the bottom to the top, but let's bounce around here. So let's talk about Microsoft. Microsoft is just an absolute giant. I think their moat is bigger than even a lot of people give them credit for. Their growth is incredible. They can set almost any price they want, and people will pay it. I think they'll have mid to low teens growth on the top line going forward. I have their operating margins staying around the low 40s, but they've basically just been improving this over time. And I've given them a similar multiple to where they've been trading at over the past few years, and I'm looking at 15% annualized return on Microsoft, which would basically be a double in 5 years. I think this is a fantastic company. I'm going to give Microsoft S tier. Let's go to Amazon. Now, Amazon is a company I love. In the past, they've sacrificed margins and profitability somewhat to expand market share and revenue really quickly. This has always been a very slim margin business because it's really capital intensive, but I think when they want, Amazon can increase their prices almost at will. I expect them to be hitting high single-digit operating margins within 5 years. I think they'll continue with double-digit revenue growth on the top line. And if I give them a 40 times multiple, which is very expensive, but I think it reflects their ability to keep expanding their profitability and also just reflects how dominant this business is, we're looking at a 10% annualized return for Amazon. That might seem low, and it was looking a little bit better when their stock was in the 170-ish range recently. But now with the price coming up, I think Amazon is between A and B in this group. I'm going to give Amazon an A. This is easily a company where if the price drops down to like 150, this is an S tier for me. Now, Google is not the most loved company by everyone. There's a lot of concerns floating around Google, especially with AI and ChatGPT. How is that going to affect their search business? Search has been massively profitable for Google. It is still the largest component of Google's business. But Google has YouTube, they have Waymo. I mean, Google has a ton of bets going on. In my assumptions for Google's future, I assume that their revenue growth slows down a little bit to 9%. Their operating margin stays right around 30%, and I gave them a 24 times multiple, which seems fair. I mean, it's a little lower than they've traded at recently, but a bit higher than they're trading at now, and I'm looking at a 16% annualized return for Google. That's another double in 5 years. I think with their stock price today, I would put Google in S tier. I mean, it's kind of between A and S, but I think Google as an investment looks good. All right, now Meta. Meta's stock has had a great run since they really crashed out in 2022. Let me update my sheet here. I don't think Meta's moat is quite as large as some of these other companies. As you remember, a couple years ago, there was a big scare that, TikTok is eating their lunch. Facebook is just for old people. And yeah, they have Instagram, but Meta's platforms might not be as evergreen as we think. And Facebook came right back and just kept on making billions and billions of dollars in earnings. Now, while I think Meta's a great company with amazing margins, I don't think Meta's as dominant as, Microsoft or Amazon or Nvidia. Growth has looked great. And if I just keep them chugging along, 10% revenue growth, their margins at 38. I keep their multiple right where it is now. you're looking at about 10% return. If I give them better revenue growth and their margins at 40, which they have been recently, then yeah, you're looking at 15% annualized return. So, I could give Meta an A. To me, at its current price, it's right between A and B. Just because I have no one in B, I'm going to put Meta in B, but I could easily have put them in A as well, I think. And finally, we have Nvidia. I recently did a video on Nvidia, and if you watched it, you know how impressed I am with Nvidia as a company and how dominant I think they are in their space. However, the price is really expensive right now, and that video was actually called Why I Don't Own Nvidia. The short and sweet of it is their price already bakes in a lot of the success of the company. Their operating margins are so incredibly high right now because they don't have any real competitors in data centers at the moment. I don't think that will be the case 5 years from now, and while I think Nvidia is going to remain the dominant player for a long time, you can see the assumptions I put in here. I mean, 40% revenue growth this year, 25%, kind of normalizing out to 15% revenue growth. So I'm assuming their revenue gets to $350 billion in 5 years, up from $130 billion now. I'm assuming their operating margins remain really high at about 40%, and they trade for a 35 times multiple. So I don't think I'm skimping on the assumptions I'm making about the future for Nvidia. I think this reflects the fact that I think that they're a dominant, incredible company, but I'm only looking at 10% annualized return for these assumptions. And if they don't hit this, if some competitor like Broadcom comes out of the blue and margins or growth are lower than we think, then the return might not be great. So to me, as an investment, Nvidia is between an A and a B, and I'm sure many of you are going to disagree with how I've ranked a lot of these companies, but this is just my opinion. If you agreed, if you disagreed, let me know why down in the comments below. We just passed 200 subscribers on this channel, so thank you to everyone who has subscribed. Let me know what companies you want me to look at next, and I hope to see you in another video.